Have you ever wondered how businesses manage to keep their operations running smoothly, even when unexpected costs or revenue dips occur? It is all about having enough readily available funds to stay nimble and secure. The primary purpose of liquidity ratio analysis is to assess a company's short-term financial health and its ability to meet its immediate financial obligations. Essentially, these ratios tell you if a company can cover its bills that are due within the next year, without needing to sell off long-term assets or scramble for emergency financing. Understanding the why behind these ratios is crucial. A lack of liquidity can unfortunately lead to bankruptcy, even for profitable companies that simply run out of cash to pay their day-to-day expenses. Two key ratios you will often encounter are the current ratio and the quick ratio. The current ratio calculates current assets, like cash, accounts receivable, and inventory, divided by current liabilities such as accounts payable and short-term debt. A ratio often cited as healthy might range from 1.5 to 2.0, meaning a company has $1.50 to $2 in current assets for every dollar of current liabilities. However, this benchmark varies significantly by industry. Then there is the quick ratio, also known as the acid test ratio, which is a more conservative measure. It takes current assets minus inventory, then divides that by current liabilities. Inventory is removed because it can sometimes be slow or difficult to convert into cash. These metrics help paint a picture of a company's short-term financial resilience, highlighting its capacity to handle both routine expenses and unforeseen financial demands. For aspiring finance professionals and those already in the field, knowing how to interpret these ratios is an essential skill. When you are evaluating investment opportunities, assessing creditworthiness for a loan, or conducting due diligence, you will scrutinize these numbers. It is not just about the absolute number, but also comparing a company's ratios against its industry benchmarks, historical trends, and key competitors. This contextual analysis helps reveal whether a company is operating effectively or if it might be facing imminent cash flow challenges. Applying these insights means looking beyond simple figures to understand the operational realities driving them. To really get an insider's view, consider the concept of working capital management, which is the daily stewardship of a company's current assets and liabilities to maximize liquidity and profitability. Another advanced concept is the cash conversion cycle, a metric that calculates the number of days it takes for a company to convert its investments in inventory and accounts receivable into cash. A shorter cycle generally indicates better liquidity management. Some companies, particularly those with highly predictable revenue streams like subscription services, might even strategically operate with lower liquidity ratios, a practice sometimes referred to as lean liquidity, as they can forecast their cash needs with greater certainty. Ultimately, a solid understanding of liquidity ratio analysis equips you with the tools to gauge financial stability and operational resilience. These ratios provide critical early warning signs, enabling investors, creditors, and internal management teams to make informed decisions. By mastering this area, you contribute to ensuring sustainable growth and effectively navigating the complex financial landscape, making it an indispensable part of any finance professional's toolkit.